So up next, we've got Dave Feldman, who literally, wrote the book on Reg A. In fact, I remember back in 2010, Dave was telling me at one of the SEC small business meetings, he sort of coined the phrase for Reg A plus, which is commonly used today. So without any further ado, I'd like to welcome my friend Dave up here. Thanks so much. I'm sorry.
Is there a clicker? Oh, there we go. Another lawyer, yay. Aren't we excited about that? Free legal advice, don't you want that? How many are here from out of New York? A lot of out-of-towners. All right, I love to tell this only in New York story. Guy walks into the Bank of New York and he says, I'm going to Europe on vacation for 2 weeks, and I'd like to borrow $5,000. And they say, well, that's fine. Do you have any collateral? And he points to a brand new Rolls Royce that's sitting right outside, and they say, that's great. Well, that'll be sufficient. And they take it down in the bank's underground garage. Guy goes away, comes back 2 weeks later, and he says, repays the $5,000 with interest, which comes to $18.27. And the guy says, we really appreciate this, it worked out well, but we checked you out and you're a multimillionaire. Why would you need to borrow $5,000? And the guy says, how else can I park my car in Manhattan for 2 weeks for $18.27? Only, has nothing to do with Reg A. I just like that joke. So look, what we want to do in the next 20 minutes, and I know I'm keeping you from lunch, is a little context and a little history, and then talking about how Reg A has gone right, because there's been a lot of talk about the challenges that Reg A has seen. So let's do that. So briefly, what hasn't happened yet, we haven't talked about how Reg A plus came about. Back in the 1930s, when the brand new SEC passed a rule in 1936 called Regulation A. The reason it was called that, it was the very first rule, apparently, passed by the SEC, hence Reg A. And at the time, it was limited to about $100,000. That's all you could raise, and it was meant to help small businesses raise money during the Depression. Over many years, the amount was increased and increased, and when we hit around 2011 and 12, the cap was around $5 million. The problem was that you had to go through full state blue sky review in any Reg A deal. And so in 2012, when we looked at amending Reg A, there were only 8 Reg A deals that year versus 8,000 Regulation D deals. So clearly Reg A was not being used except by a couple of kind of questionable, unsavory types. Under old Reg A, you didn't have to do an audit. You could only trade on the pink sheets. Again, it was limited to US and Canada. We've still never determined why in the 1930s rule they said US and Canada. If they were trying to help the US during the Depression, why did they include Canada? We don't know. Nothing wrong with them. The old Reg A required testing the waters only before you file with the SEC. And you had to be a non-reporting company. So that was old Reg A. Then the Jumpstart Our Business Startups Act, let me step back 1 second. In the 1980s and 90s, we had a robust small cap IPO market. There were lots of smaller underwriters that were taking smaller companies public, lots and lots of them. And they did 10, 15, 20, $25 million IPOs. We worked on those of us who are old. And in the year 2000, for a whole bunch of reasons that are the subject of a bunch of studies that none of which is clearly coming to a conclusion, it all stopped. The IPO market for small cap companies stopped in 2000. There was a market crash at the time, but that wasn't the reason. There were a bunch of potential reasons. We're not entirely sure. In the 2000s, a lot of us worked to help these companies, which still could benefit from a publicly trading stock, to go public through alternative means like reverse mergers. And we kind of helped bring those into legitimacy and transparency by doing them the right way. But it was an awkward way to go public, for sure. And in around 2010 and 11, there were a series of alleged scandals involving Chinese companies that did reverse mergers, and that kind of ended reverse mergers in terms of their attractiveness. Also, the SEC passed some new rules that made them even less attractive than that. And that's when I kind of went to this SEC Small Business Conference and said, what if we tried to improve Reg A? And I just sort of blurted out, call it Reg A plus. And in the recommendation that came out of that conference, they used that term Reg A plus, and that's how it came into parlance. So only 11 months after that SEC meeting, Congress took it up in the Jobs Act, and I spent a lot of time working with Congress, and in particular the staff on the House side, sorry, Dina, and in particular Congressman Schweikert's office, we would have been happy if they went to 30 million cap. We were thrilled they went to 50 million. As you know, they did preempt state blue sky review. I said, don't even bother doing this change if you don't do that. They said you can do an audit. They left a lot to the SEC. If you get nothing else out of today, pay attention right now. And that is when you're working with private companies who are raising venture capital rounds of money, and they do traditional what are called registration rights. Registration rights for a venture investor says, if you go public, we have the right to have our shares included in that public offering, and we have the right to have our shares become publicly tradable. The way those registration rights are written, it only applies to an IPO with an SEC registration statement. Technically, Reg A is an exemption from registration, so when you're doing registration rights, add in a provision that says, or Regulation A offering, or sometimes we can say registration or offering statement. Okay, now you can go back to sleep. So as we know, 2 tiers were created in the rules that the SEC finally passed. Took them 3 years to pass rules under the 2012 Jobs Act. They added that you can test the waters pre and post offering. They said blue sky preemption only applies to tier 2. They added this sort of brilliant idea of reduced what we call light reporting under tier 2 if you stay in the over-the-counter markets. And tier 1, they left in place sort of like old Reg A. You don't have to audit, you're non-reporting, but you have to do full blue sky. And I kind of agree that tier 1 is very difficult to do. However, if you're doing a relatively small offering in 1 or 2 states that you think are fairly easy to get through blue sky, it's not a crazy idea to consider a tier 1 deal. What they did do in the final rules was say, if you want to become a full reporting company, which you would be required to do to go to NASDAQ, we're going to require the disclosure levels to be higher, the same as what would be in a traditional registered S1 offering. Otherwise, there's somewhat reduced disclosure requirements in this Form 1A as has been discussed. And in the new rules, we're still limited to US and Canada. They've never really given a reason why they wouldn't expand it. I think they're kind of saying, we don't want to give this to China, but we can't say that. So we just say US and Canada. One interesting Reg A feature that people don't talk much about is your financial statements in your IPO can be as much as 9 months old. With an S1 registration, your financials cannot be more than 135 days old. So for example, Chicken Soup for the Soul went public almost 2 years ago. In August of 2017, they had no 2017 financials and went through and traded on NASDAQ. And the SEC passed guidance that basically says, if you do that, you have a limited amount of time to do filings to catch up on those missing quarters. And as has been mentioned, in December of last year, Congress passed a law that permits full SEC reporting companies to use Reg A, and we'll talk more about that in a second. You cannot, as Lou pointed out, do an at-the-market offering. You can't be a shell that does a Reg A. You can't be an investment company. You can do confidential filing. I somewhat disagree with those who say the light touch period is over. We worked on a deal less than 6 months ago that got less than 20 comments in a pretty complex deal. So I think it's just about what your experience is. All right. So what's been going well? As Stephen stole from my presentation earlier this morning, the SEC reported that last October that 123 deals have been completed as of 6 months ago. Since the beginning of Reg A, which technically was 2015, but we'll get to why it's really later. As we noted, $1.3 billion has been raised, an average of $10 million a deal. That's up from the year before, which was around 8.8. So the number of deals are up. The average size of the deal is up. So the use of Reg A is definitely increasing. Most of the companies are trading over-the-counter or non-trading, as we talked about. The over-the-counter markets, Cromwell Coulson changed their rules to allow these light reporting companies to trade on OTCQX or QB, which they wouldn't have been if they weren't full reporting. Elio Motors was the first big success in 2016, raising $18 million with no underwriter just by emailing all the people that had pre-ordered their three-wheeled car. Other good things that have been happening. Community banks have discovered that they can go out to all their thousands and thousands of depositors and say, will you invest in our company and help us go public? And about a dozen of them have done so. They trade over the counter. Almost all of them, their stocks are up. Several of them have been sold since then. That's been a nice success. REITs, as has been mentioned, the real estate companies, companies like Fundrise that has done 50 million, 50 million, 50 million, 50 million over and over and over. The way the REITs work is they don't trade. They do a widely based offering with testing the waters to accredited and non-accredited, and at the end they don't trade the stock. However, they give you a quarterly right to be redeemed, to have your stock bought out at the net asset value. There were 10 companies that have gone to NASDAQ. We did the first one called Myomo back in June of 17, which was a difficult macheteing process getting through the rules. No question the stocks have struggled in those companies, and there's a lot of discussion about that. I think we need to have more realistic valuations. We need to have more market support in advance. These are the things that I think might make a difference. But testing the waters and bringing these deals to Main Street has been exciting. The opportunity for average folks to invest, to get in on IPOs, and the whole testing the waters thing is kind of exciting. There's been a lot of discussion about it. A couple of warnings about testing the waters. One, remember, every communication you develop not only has to have a disclaimer, but it's going to be filed with the SEC. So whatever you're writing down in these communications, make sure it's in a form that you're comfortable that's going to be publicly available. The second thing is interviews. If you're doing an interview on CNBC or New York Times or whatever, technically you can't during testing the waters because you don't have an ability to put a disclaimer on that. So be careful with that. We really are only not even 3 years into Reg A, and that's what people need to realize. This is inning one. And so when people talk about it's not doing well, et cetera, it's really just getting started. Even though the rules were approved in June of 2015, there was an immediate lawsuit by 2 states, Massachusetts and Montana, who didn't like that the state review was preempted in Reg A. So they brought a lawsuit saying the SEC didn't have the power to do this, and if they did have the power, they went beyond their power. And it took a year, and finally the appeals court did dismiss that case, and they allowed everything to go forward. But very little on the deal front was happening while that case was pending. So we're really talking about July of 2016 is when things really started. So it's still pretty new. And now we have reporting companies allowed to use this. The one thing with that is it's a nice development, but it only has a limited benefit because if you're a public SEC reporting company and you've been reporting for at least a year, you have short form S3 available to you, which frankly is it's a much easier way to do a public offering than even a Reg A, because S3, it's a short form filing. You don't put any substance in it. It gets approved by the SEC in a matter of a couple of weeks typically. And so the only companies that benefit from being reporting and using Reg A will be those who are trading over the counter and who have less than a $75 million market cap. Those companies don't have this short form available to them. Or if you're a newly public company, you can't use S3 for 1 year. We're going through this right now with a public company we did an IPO for 10 months ago, and they want to do a follow-on offering. And we said, just wait 2 months, you can use S3. They said, we can't wait, we want to do it now. And they're insisting on an S1 because the underwriter just isn't comfortable doing Reg A. But the point is, Reg A could be used for less than 1-year-old public companies. I'm almost done, I promise. But just looking at today's deal flow sheets that we all got, if you look at the page on Reg A, there's about a dozen deals on there that are currently going on. And of those, 2 of them are REITs, 4 of them are service companies. One's a chemical company, one's a radio station company. I used to own a radio station. And one's retail. So there's deals going on for sure. So there's a potential, as we say, for growth, and maybe the higher tier of underwriters will come in. Getting a larger maximum would be a huge, huge benefit. I think Dina talked about, you know, we did this in Congress thinking about like biotechs. And what they didn't realize is that biotechs want to do deals to go public that are bigger than 50 million. And the deals we see going on are actually kind of in that 50 to 100 in a lot of cases. And so if we could get the raise amount up to 75 or 100 million, I think you might see more of those biotechs come in. Another exciting potential with Reg A, and here's where Reg A could be cool, and that's cannabis. And our firm, you know, we're an 800-lawyer global firm, and one of the other things I do is I'm a team lead for our 50-plus lawyer global cannabis practice. And cannabis companies can benefit from Reg A. Why? Because they're mostly prohibited from trading on NASDAQ or the New York Stock Exchange for now, which means they have to trade over the counter, which means if they're going to do a public offering, they have to do it over the counter. If they do an S1 over the counter, they have all this blue sky problems. With Reg A, they avoid that. And so, for example, High Times magazine is going public through a Reg A as we speak. Another company called MedX did the same. We're working on 2 others right now. So keep an eye on those. NASDAQ has just proposed a rule, as has been mentioned, that would require a Reg A company to have at least 2 years of operations before applying to NASDAQ. And I think that's a good thing. Several of the companies that have gone through and gotten through NASDAQ somehow haven't done well, and in part it's because they're new companies, they're just figuring stuff out. I think this is probably a good idea, but it also means, because they're proposing this, I think it means they want to encourage more people to use Reg A. It's not like they think Reg A is bad, they just want different companies to use this. And the other thing I think the SEC was trying to do and Congress was trying to do is get rid of reverse mergers, because the SEC can't regulate them, can't stop them. And I think they've effectively done that. But again, this is the early stage. It's, as we call, the shakedown cruise. I grew up sailing. There's a lot still to learn, but what we're seeing is that this is a much lower cost option, as Mark mentioned. This is a faster process. There is lower disclosure and reporting. And, you know, Wall Street tends to work in a herd mentality, and we want to see the herd move a bit more in this direction, and we think that there's a great opportunity still to do that. And the only last thing I'll say before I open to any questions is blatant promotion for my 17-year-old son, who just took over as the star of the Broadway show Dear Evan Hansen. And so all of you should go out and buy tickets for Dear Evan Hansen very soon. Any questions? Yeah. There is a mic. I don't know where it is. Oh, it's up there.
David, Media Shares is representing a company that is, it's actually a pink sheet company right now that wants to uplist to NASDAQ. Does it count? They merged and they became a new company some time ago, and does it matter that they are a pink sheet company? Would NASDAQ count that as their 2 years in operation in order for them to uplist?
There's a thing we do in the cannabis industry a lot, and it's this. I don't know. I read the NASDAQ proposal. It's very simple. It's very short. It just says the company applying needs to have had 2 years of operations. I think they'll look at real operations. If it was a shell on the pink sheets, I doubt they'll count that. If it was an operating company, but they may say, well, you were a different operating company, now you're this operating company, we're going to count the 2 years towards this operating company. Remember, the exchanges have a wide amount of discretion in deciding whether to take companies on or not.
That's a new regulation that's come in?
It's a proposal that they've made that the SEC has asked for comments on. It appears, I think it's likely the SEC will approve it. And by the way, New York Stock Exchange for now has suspended taking Reg A listings as well. I think there was one scandal. This company, Longfin, faced SEC scrutiny. The issues they have nothing to do with Reg A, but it's kind of gotten lopped into that. And that's a big part of that, and watching these stock prices go down. Yes, sir.
Here you are, sir.
So on the last panel, a crowdfunding lawyer said that she consistently advises her clients that are pursuing Reg A to forget about the secondary markets, whether it's OTC or NASDAQ. Do you share that perspective, and is that what you are telling your clients?
No. Well, I would say something slightly different, which is don't pay much attention to trading in the early months after you go public. It's very, we used to say this in reverse merger days when, when the mindset with IPOs is, what's the first day of trading like? Everything matters based on the first day of trading. With reverse mergers and also with Reg A, I've tried to get companies to change their attitude and realize that market support will build over time and that you shouldn't expect it to all happen right at the beginning. And so where you trade can matter because you certainly don't want to see a ridiculous nosedive of your stock. But post-reverse merger, in many cases, the stocks typically do go down. And then eventually, if your fundamentals are there and you get strong advisors helping you sell your story to Wall Street, you'll find that success with your stock. Way in the back. Let's see how well you throw all the way back there. Go ahead, Lenny. I also want to thank Stephen, DealFlow, everybody for keeping this going, and I think the discussion's important.
Dave, in my practice, I actually discourage people from commencing trading until towards the end of their offering, because it's the only time you can actually legally determine the price, whatever the Reg A offering price is. What do you think of that philosophy?
Well, that assumes you're going to do more than one closing, right, of your offering. Most of our deals, we do one closing and then we trade. If you're looking to do multiple closings, in some cases they wait to trade because they worry that if it trades down and their stock price is $5 and it's trading at $2, who would pay that price? So in most cases, it's probably a good idea to wait to trade until your offering's completed, if you can. Sometimes it's hard to do. Yes, sir. Let's get the bubble back.
You. Any other questions?
This gentleman, yeah.
Okay. There you go.
Thank you.
I know we're hungry.
Could you just quickly comment on brand new companies raising Reg A?
Yeah. Brand new companies raising Reg A. I think you want to look carefully at it. I would not say don't do it. I think what I always say to people that were considering reverse mergers or Reg A, there is this mindset with IPOs that says you must be a mature, seasoned, profitable company to do an IPO, and I don't agree with that. I think that you should ask two questions. Can we benefit from being publicly held, and can we bear the cost of doing so? And one of the issues that was raised on one of the panels was a lot of companies go public and then they can't afford the cost of being public. So that's an important factor. And when we say benefit from being public, that means the number one reason people go public is easier access to capital. If you're a public company, it's easier to raise money. However, that money should be there. If you're a pure startup, will pipe money come to you? It depends, as lawyers often say, right? If you're a blockchain company, it might be more likely to come, or if you're even a cannabis company, which is a hot space right now, there are companies, so if you're in a hot space, in a hot industry, maybe, but as a startup, again, it depends why you're going public. Some of these cannabis companies, for example, they're growing by acquisition, and they're making a lot of deals, and the way you want to do that is by using your public stock as a form of currency. So if you could see a benefit to being public, and you can bear the cost of doing so, it's definitely worth considering. Other questions? Everybody's hungry. All right, so with that, let's go to lunch. Thank you.